Hello and welcome to this session in which we would look at analytical procedures when it comes to the notes payable and specifically the capital acquisition and repayment cycle. The substantive analytical procedures involve what? Comparing numbers and relationship within financial data to find inconsistency or unusual trends. I know you heard this statement from me several times because every time I cover a cycle, I do look at analytical procedures. So when you audit accounts payable as part of the acquisition cycle, we will be using analytical procedures. So for what purpose? Well, to detect any omitted debt or unrecorded interest expense. So analytical procedures will help us determine whether we have any debt that's hidden or certain interest expense that are not properly recorded. It might help spot overstatement that might be masking financial risks. That could be the case. Or it might identify accounting that does not make sense based on the company's real activity, which is borrowing in the situation, paying off the notes, so on and so forth. Now, it's a sin, in my opinion, in quote, a sin not to use analytical procedure when it comes to notes payable long-term debt. Why? Because analytical procedures would yield a lot of useful, beneficial information, and that's why you need to use it. So in this session, we'll dive into analytical procedures specifically for notes payable. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Our audit course is best for online students and students who are struggling in their audit courses. We cover the essentials from audit reports, internal control, ethics, evidence, sampling, planning and materiality, assurance and non-assurance services, and of course, the accounting cycles. Our comprehensive course includes lectures, multiple choice, true-false questions. Go ahead and start your free trial today. We are here to help. Your success starts here.
So when to use analytical procedures? I know I say this again several times. There are three stages where analytical procedures could be used. First, at the beginning of the audit. You would always have to use analytical procedures as part of your risk assessment. You would scan the big picture for anything out of the ordinary, and during this step, it is required. During the audit, it's optional, but strongly recommended for a cycle like notes payable and to compute interest expense. So during the audit, this step is optional. You don't have to, but you should perform this step. It's optional, but strongly recommended. At the end of the audit, it is required. Analytical procedures is used again to make sure your findings line up and you have not missed anything that's obvious. And that's what analytical procedures will show you. Things that are too obvious that you should not have missed, or it will point out to areas that need further investigation. We will start by looking at some of these analytical procedures to put them into practice. One powerful analytical procedures is pre-calculating expected interest expense based on the average notes payable. So what you do is you compute your own interest expense based on the average loan balances to determine if the number makes sense or if they are close. A straightforward but powerful way to check how much interest expense should exist, given the prevailing interest rate. So how do you do that? You sum up all the monthly balances of all the notes payable for the year, calculate the average monthly balance, identify the average interest rate for all the notes, multiply the average balance by the interest rate to get a monthly interest expense, then annualize that interest expense. Well, exactly how do you do that? You would look at the average notes payable is $1 million. The average interest expense is 10%. The expected monthly interest expense is $100,000. Therefore, the annual interest expense could be $1.2 million. Again, we're looking here for averages for the loan balances. The averages of the interest rate is 10%. So what does that mean? So interest expense should be approximately $1.2 million. So once you have this number computed, you compare directly to the reported interest expense. If the number is around 1.2 million, you could say, yeah, that sounds good. If the number is 1 million or 1.4, then you'll have to look a little bit more. So any large gap can point to omitted or misstated notes and errors in accrued expense. So you could be hiding the note, or you could have made a mistake computing the interest expense. Or there could be other reasons. Some of that interest expense should be capitalized, but it's a place to start your investigation. You would say that the expected should be 1.2. Why is it 1 million? You'd have to do some computation. Another analytical procedure is to compare individual notes outstanding from year to year. What does that mean? Is you would look at the loan balance for a particular loan from year to year. That's another useful approach. You would expect to see reduction over time due to principal payment. If you're looking at two loans, year one and year two balance should decrease, assuming you did not add any loans to that loan that you are investigating. So it should be a reduction. You would only see an increase only when new borrowings happen. If you went and you refinanced this loan, then it's a different story. So if balances remain unchanged or unexpectedly rise without a clear reason, that's a sign to dig deeper. Why? Because what should happen to loan balances from year to year? Loan balances should go down, assuming you are making payments, and you should be making payments. No lender would expect you not to make a payment. Now, you could be making only interest payment, and that could be the case, and your balance remain unchanged. Or you might be falling behind, and as a result, your balance is going up due to penalties, unexpectedly rise. But you have to have a reason. And if it's unexpectedly rising and you're having problem paying off your loan, then you have a deeper issue. You might have a going concern issue. So the point is, you should see what should be the norm, and if it's not happening, why not? And from that why not, you should learn more about the company. What should you do now? Go to Farhat Lectures, look at additional resources, multiple choice, true, false, additional lectures that will help you, whether you are a CPA exam candidate, accounting student. Invest in yourself. That's the best investment you can make, and good luck.